High yield income funds are really popular with investors because they give you instant access to a diversified basket of income producing stocks. In an aggregate, you get a nice yield, but you also get the benefit of broad diversification so that if even one or two of the underlying holdings in the ETF cut their payout, the aggregate yield is still hardly impacted at all. In fact, it may still rise depending on how the other stocks in the fund are doing. If they're growing their distributions at a fast rate, it can offset those cuts and actually lead to continued dividend growth. You see this with ETFs like the Schwab US Dividend Equity ETF that have consistently grown their dividend year after year. In fact, over the past 10 years, SCHD has grown its payout at about an 11% CAGR, even though some of its underlying holdings over that period of time have cut their dividend. So that shows the power of ETFs. It also has that psychological benefit because if you're just investing in individual stocks, even if in aggregate your portfolio is effectively like an ETF itself, you're more likely to focus on each of those individual stocks. And so if one of them crashes or cuts its dividend, you're going to feel that much more psychologically and emotionally than you would if you just held all those stocks in ETF and you just looked at the wrapper ETF price for that day and saw that it didn't budge that much. It makes it much more easy psychologically to continue holding and adding to a stock position or an ETF position over time. And so those are some of the big advantages of investing in these diversified funds. Of course, also it helps that you don't have to do individual due diligence on stocks. Instead, you can just trust the fund to run its course either as a passive managed like algorithmic fund or as an actively managed fund where there's a manager who's doing the management on your behalf. So with that being said, what is my favorite high yielding fund today? If I could only buy one ETF, not necessarily to make up my whole portfolio, but just one that I like the most right now that I think is the best opportunity, what would it be? In this video, I'm going to talk about what it is. Before I get into the video, if you could please give it a like, that would really help me out with my channel. Help be a big thank you to me for putting together this content for you for free. Thank you very much. Okay, so what is this fund? Well, it's the Global X MLP ETF. It's ticker symbol MLPA. First of all, you may be thinking, okay, you pull up the chart and you may think, okay, look, over the past 10 years or so, MLPA has not had the best track record. You saw that probably that it's crashed heavily in 2020, probably crashed a couple times before then as well. It's cut its dividend on numerous occasions. So you may think, Samuel, why are you picking this fund? There are many others out there that have much better track records. Well, I would answer with a few things. First of all, that kind of analysis where you're just looking at the past is like looking in your rear view mirror when you're driving. Now, certainly there's a place for that. That's why you have a rear view mirror. I'm not saying you should completely ignore the past, but when you're driving and you're making decisions, it's much more important to look through your windshield. And so my analysis here is going to be a windshield analysis. Primarily, it's going to be focused on what is ahead for the fund, what is ahead for the sector, the MLP sector that the Global X MLP ETF is focused on. And that's what drives my analysis primarily, not the rear view mirror, although I do take a glance at it just to have some context and have some understanding. And really, on that note, that's why I wouldn't just put everything into the Global X MLP ETF. I realize that like any sector, it goes through hard periods. It's had some growing pains as a sector. And so, yeah, I wouldn't put everything into the MLPA either. But I do think it is a good ETF that if you want a portfolio of just ETFs, I think it's worth holding. And here's why. Okay, so the biggest reason why I like it as opposed to other MLP ETFs like the Illyrian MLP ETF or even some CEFs like KYN, NML, and others is because it has the lowest expense ratio of just 0.45%, whereas AMLP has 0.85% and most of those actively managed funds have expense ratios well over 1%. Additionally, MLPA is not levered. Same with AMLP, neither of them have leverage, which reduces the risk significantly compared to some of those actively managed CEFs like KYN, for example, that has quite a bit of leverage on its balance sheet that puts you at risk during a market crash where they may have a margin call, have to sell some of their securities near the bottom, lock in permanent impairment, and likely having to cut their dividends. So that's another reason I like MLPA is because of its more conservative structure. Why else do I like MLPA? Well, it has some of the leading blue chips in the sector that dominates portfolio like Enterprise Products Partners, Energy Transfer, MPLX, Western Midstream Partners, Plains All American Pipeline, and so on and so forth. So it has really high quality investment grade MLPs in its portfolio that undergird its overall holdings. And so that gives me a lot of confidence that the payout is going to be sustainable and likely continue to grow moving forward. So that 7.3% yield that it currently offers, which is very attractive, is not only likely going to be sustainable, but actually likely going to increase at an inflation beating pace as it has in recent years moving forward. And so I'm really bullish on the yield plus dividend growth that MLPA offers. What else do I like about MLPA? Well, one thing to keep in mind is that it issues a 1099 tax form. Now, I know many my viewers and comments when I've talked about MLPs like Enterprise Products Partners, Energy Transfer, et cetera, in the past, you've said, well, it issues a K1, that's a no-go for me. Well, MLPA issues a 1099 tax form. So it holds all those K1s and then issues you a 1099 instead. So it really takes away a lot of the pain and suffering that comes with K1s. Now, personally, I don't think K1s are that bad. I do my taxes online. Takes like 5 minutes per K1. It's not a big deal, but for some of you, maybe you don't like dealing with the K1, or perhaps you're looking for a midstream to hold in your IRA or your 401k. You don't want to deal with the UBTI tax risk that comes with having K1s in your portfolio, so maybe you want something else, and I think MLPA is a compelling option. In fact, I would strongly suggest holding MLPA in a retirement fund as opposed to a taxable account, because it does have the risk of double taxation. Since it's taxed as a C corporation, it has to pay taxes on its profits, but also you have to pay taxes on the dividends. They're no longer purely classified as return of capital. A part of it are classified as return of capital, but a big part of it is actually taxable dividend income. And so that is an issue that I think makes it worth holding in a IRA or a 401k instead of a taxable account. So just not tax advice, just my opinion based on my own experience and my observations, what the best and most efficient way to hold MLPA is. But back to the fundamentals, why am I now so bullish on MLPA, and I don't think it's going to have a repeat of the disaster of 2020 and some of those other previous years? Well, the MLP sector as a whole has come a long way since then. You have balance sheets that have been deleveraged significantly. Their leverage ratios, virtually all of the major MLPs, have plummeted over the past 5, even 10 years. And now they're no longer dependent on issuing equity to the markets to finance their growth as was the previous model. But now they retain a lot of their cash flow and they fully fund their growth profiles. Virtually all the big names in the sector, that's what they're doing. They have, again, low leverage ratios, well-laddered debt maturities. That means that with their free cash flow net of their distributions, they're really not ever dependent on the capital markets. They can pay off debt if they choose to on any given year instead of going hand in hand. Now, if they can get a decent refinancing rate, they will go to the market and refinance their debt, and that's fine. That's their purview. That's how they do it to keep their return on equity high. But they're not a slave to the market, and that gives a great deal of security, especially to the payout. Additionally, they have high coverage ratios. Energy Transfer has a coverage ratio of about 2 times. Enterprise Products Partners has about 1.7 times. MPLX has about 1.5 times. And so, that's pretty typical. They have high coverage ratios, which means they have a lot of extra cash flow left over after their distributions to fund their growth profiles, to potentially opportunistically repurchase their common units or even their preferred equity, which Energy Transfer has done recently, and Plains All American has implied that they might do as well soon. And so they have those opportunities to further increase shareholder value or unit holder value. They also are positioned to potentially deleverage further, and most of all, grow their distributions at an aggressive clip. EPD and ET, both of those are likely to grow their distributions at a mid-single digit clip. MPLX expects to grow at a double-digit annualized pace for the foreseeable future. Plains All American Pipeline is likely to do the same. Western Midstream is guided for a low to mid-single digit growth rate to combine with its very high yield. So you have this profile ahead of it that looks like a very strong growth runway for MLPA as an ETF in terms of its dividends. So when you combine the 7.3% yield with likely 4 to 7% annualized distribution growth for the foreseeable future, we're looking at a mid-teens annualized total return profile for the fund without even accounting for additional capital appreciation. But I think capital appreciation could very well come in play because, again, when you have that high of a yield with a solid growth rate, that's not only being bolstered by the strong balance sheets and the organic growth opportunities that they're locking in, but favorable regulatory environment with the Trump administration being very favorable to MLPs and energy infrastructure in general. You have the AI boom and the onshoring of American industrial activity under the Trump administration that's further going to increase demand for energy infrastructure, which will drive more growth and more demand for their assets. So you have all those. You have the export boom of energy from America to other countries that seem to be at the center of a lot of these trade negotiations with countries in Asia like Japan, South Korea, Taiwan, even China. That was a big chip the Trump administration used in their recent negotiations with China with the export of ethane. They were able to use that to get China's export restrictions on critical minerals and rare earths lifted. And certainly Europe wants to be increasingly independent from Russian oil, and so that will increase demand for U.S. energy exports there as well. So there are so many tailwinds for the sector that can drive strong growth moving forward, and capital appreciation as the valuation multiples assigned to the sector increase as the market becomes increasingly optimistic about the durable economic viability of these existing infrastructure assets. In fact, even maybe the organic growth potential, that recontracting could be on favorable terms because of this strong growth. Additionally, Israel just attacked Iran, which has caused oil prices to spike, and that is a big tailwind for MLPA, because certainly if oil prices are rising, that generally makes the infrastructure that transports them more valuable as well. So for all those reasons, I really like MLPA right now. Yeah, again, it's a concentrated fund in the midstream sector, and so there are reasons to want to diversify in other funds like SCHD, maybe JP Morgan Nasdaq Equity Premium Income ETF, or other funds that give you broader exposure to the market while still generating attractive yield. But I think MLPA has a lot going for it. And so if I was to build a portfolio of ETFs, MLPA would be in it. Now, I personally invest in the individual MLPs because they're more tax efficient, and I think I can generate alpha by focusing on the most opportunistic ones at any given time. And that's what I do at High Yield Investor as I build my portfolio of individual high yield stocks that have crushed the market over time, thankfully, due to my capital recycling strategy and my focus on the highest conviction names. But again, for those who want a more passive approach and just want ETFs or other funds, I think MLPA is a great option out there. Again, if you like this video, please give it a like, subscribe to my channel to get more content like this, both my top ETF picks and my top individual stocks moving forward. Thank you very much. See you next time.